Good afternoon. This is Ken Long at Tortoise Capital with part three of our series on pinch and stretch. So now we're going to take a look at a couple case studies. So here we have from our daily report a couple symbols, IBM and ILF, that were in the category of the most compressed pinch box. If you think back to the daily report, we're looking at the most compressed pinch box. These are the ones where of the 60 symbols in the Dow 30 and the ETF 30, we have the minimized pinch, and they're more than one standard deviation below average compared to their historical performance. So here's a case where we have IBM and ILF. And so if we look at both of those, when we call them up on daily charts, we notice that on the daily charts, IBM is clearly pinched. You see how the Z3s are very tightly compressed, and the same thing in ILF, tightly compressed. And then we notice that uh, both of their prices are sitting right on their Bollinger Band mean. Now that's actually a good thing. That's the absolute middle of a very narrow river. There has been zero movement in either direction, and so that becomes an important moment before any directional movement has occurred. And you see, in each case, there is some distance from the RL10, which has pulled away from the 270. Now there is a measurable distance to the 270 in both cases. And so we're going to look in on IBM first. You notice that I've drawn the green line and the red line for the mechanical entry on daily charts. We're going to zoom in now and take a look at that. So what I've done here is you notice this was probably a super pinch right in here. This one was certainly a super pinch. I think this was just a regular pinch now that memory serves. And we got this large unambiguous move down, and then the price gets abnormally pinchy for 30 days, and that creates this pinch condition. You notice it's not a super pinch because we have the 270 up here, the 90 down here. And so what I've drawn is a breakout from above the Z3 or below the Z3 would trigger a directional move in either direction with about a $9 risk between those two for execution. So that's what the trade frame setup looks like on daily charts. If this breaks out, the first step would be to get back to the 270, and then we would think to the top of the dragon hump around 180 for our almost 3-to-1 return. So now what I'm going to do is drill down to the 30-minute chart, which is either a very slow intraday trade or a fast swing trade. And what I want you to notice is that when we zoom in, we see the price patterns and the RLCO framework and the Bollinger Band stretch and pinch. But now on 30-minute charts, we notice that the daily prices for action on the daily charts are a considerable distance away. This is the green line from the daily that if it took that out, we would have a reason to get long mechanically and short at 150.44. So we're looking at the green and the red line from the daily. When we look down at the 30, there's a lot more going on. And now in our RLCO framework, we would actually be entering here at the green line. This is an intraday pocket opportunity because what we had was an unambiguous move and then an RLCO outside the river, the RL10 crossing the dragon rolling up, the 30 rolling up. There's actually an owl entry here. And then if this had gotten us out and makes a higher low compared to the previous swing low, then this becomes, then this actually becomes a pocket entry or a P4, a lazy W entry, particularly with price crossing the RL270, and it's now moving upward. So this would be a intraday pocket trade with an entry around 153.50. And now if this thing behaves and gets to 156.80 like it could very easily do and takes that out, then we got an improved entry at 153 when we would be happy to enter at 156.80 and added 3 extra bucks of price improvement And then in terms of execution risk, we could easily see taking a stop for execution at 152.50, so only $1.30 of actual execution risk, because a price below the blue line would suggest a collapse of this support level, and then we would probably even stop in short here with a target of 150.44, and then if that were to collapse, we'd certainly have reasons to add a second position, or we'd be satisfied with the $2 of price improvement on the short side. Now, if we now keep in mind where that green dot is. Now, when we shift down to a 10-minute chart on IBM, you can still see the mechanical entry prices. And now what I want you to notice is that intraday there's a opportunity down here when it comes out of the Z3 pinch and gets a Z3 excursion. There's a 1, 2, 3 entry possible in here, or a Z3 PC stop and reverse. And then the green dot here is where we saw the price action on the 30-minute chart. Now, by compressing the prices so tightly on the 10-minute chart, it looks like there's hardly any movement distance in here, but this is almost $2.50 of movement. I had to compress it that tight in order to see the daily chart entries at 156 and at 150. And so what looks like absolute noise to a swing or position trader does actually allow some intraday activity in between those price points. If I then further drill down to the 1 minute, you notice everything here is inside the yellow from the 10 minute. So on the 10 minute, if I'm looking at all this price action in the yellow, which it looks like noise to the day trade to the daily chart trader, on the 1 minute we actually can see that there are some there is a low, a higher low. This is actually an owl entry and an RLXD exit, which gives us about 50 cents of organized movement because we have an upward bias because of the RL270, and we see a Z3 excursion. This would allow us an owl entry. This X with the green dot is actually where the 30-minute bar, the 30-minute charts were entering, so we can actually see a couple trades prior, and then this could actually be a second entry, or this first one is now seen as a price improvement over the P4. And if you had to just settle for the P4, you would certainly be happy to take that. It's on a rising lows, it's a low, it's a higher low, a third higher low, and then we're crossing the RL270 and we're above the VWAP, and all we have to do is clear this resistance and have some gains. Here's the first trade. It fails to fail further. You get a pocket re-entry. So there's a couple trades that are available to us on the 1 minute charts. And the thing to notice is that when you zoom that 1 minute chart back out to encompass the whole day, and then scale it so that you can see the daily charts, this clearly looks just like noise, and you can't even see any trade opportunities in there. But on different time frames and different scales, visually, there are ways in which we can manage trades in what the longer term traders would consider to be noise. In the same way, we're going to now take a look at ILF, the other trade case. It's pinched on a daily chart, and I want you to notice price is right smack dab on the Bollinger Band mean. The 270 is outside of the Z3 pinch, but the other elements of the super pinch are in place. It's pinched, and there's the 10 and the 30 and the 90 all tightly clustered, and not so far to the RL270. Well, actually $2 to the 270. So there's that's actually an 8% move available just to get back up to the previous hump of the dragon and the RL270. So here we are, a setup where we have a pinch and price right on the 30. On the 30-minute chart, these yellow dots now are opportunities for us to have gotten an owl entry, a breakout from a Z3 pinch, and then a continuation pattern up to 32. And 32 is where we saw on the previous chart some opportunities to get to the RL270. So on the intraday chart on the 30 minutes, Again, this is either a fast swing or a slow day trade. There are opportunities with our LCO framework to work some of our magic. On the 3-minute charts now, I want you to notice how the um, the great deviations occur early in the day as price accommodates now, or the Bollinger Bands now accommodate two gaps in price action from the close to the open. So the gap does affect the Bollinger Band means, but I want you to notice how orderly this move is and why we're interested in rising lows and tapping into those pocket entries. And you can see those opportunities on daily and 30-minute charts and dial in to get improvements on 3-minute and 1-minute charts. I want you to notice the fractal nature of these patterns as well. And so this is this is EWW on a daily chart, and I want you to notice the pinched price action here, and price sitting right on that Bollinger Band mean, and this is really a 1, 2, 3 potential entry here. I want you to notice on the daily chart the Z3 excursion, and how quickly that gets corrected, and the primary trend continues up. The river is up, rolls into a congestion pinch area, one head fake, and then the strong trend continues. This yellow dot represents the beginning of trending behavior on the daily charts, because now price, the RL10 and the RL30 have both left the river, and that's the beginning of trending behavior, and you have a nice price trending action right here. This is a 1 and a 2 sigma stretch away from the Bollinger Band mean now, I want you to notice. And then we have a large stretch depth between the RL270 and the RL10. The RL10 is here, and the RL270 is here. So this is the difference between long-term fair value and where the traders have pushed that price. And so if we're into this trade from either the 1, 2, 3 entry or a pocket entry here at the beginning of P4, or if we were in this from a 1, 2, 3 entry after a Z3 excursion, if we then had a stretch up above Z2 and then a large gap up at Z3 and then starting to fail, we would notice that this is a 1.2 sigma stretch already from the Bollinger Band mean. So lock it in, because it's already an exceptional move and starting to fail after a gap that got up to Z3. And then certainly we have a large stretch stat from the RL10 to the RL270 that also tells us this is a much larger move than we were maybe entitled to believe in. And because it's a broad country integrated market, the probability is a reversion to the mean out here. This is one where we would absolutely lock that trade in. And so what I want you to notice on this chart then is just how on a daily chart it doesn't look like much is going on, but as you start zooming in and start framing from the daily and then drill down to your 30, 10-minute, 3-minute, 1-minute charts, you keep those markers on there so that you have some sense that if price were to work, the price at which there is confirmation from the higher time frame now gives you information that you can use inside this trade frame. So this is the way that we use multiple time frames to help structure our view. Now the math of the spreadsheets that lurks behind all of these pinches and stretches is really just a building block, and I just want to give the math geeks out there an opportunity to look at things. So we have the symbols for all our targets of interest. We're using Excel to make all the computations for the values of the moving regression lines using some Excel math functions. We're using XLQ, the Excel add-in, to fetch all the prices in order to perform the math on it. We're computing simple moving averages, the percent of the standard deviation of 30 days of price, the actual dollar value of the 30 days of price standard deviation. We take that number, divide it by price to come up with the percentage of the SD. That allows us now to compute the the distance from the moving regression lines to the Bollinger Band mean, which then allows us to convert that into Z-scores. We use some assorted statistics to find out for all 60 symbols that are in this stack, the one that has the greatest standard deviation move of the 270 away from the price is over 14 SDs away, and the one that is closest is 0.03, meaning it's right on the SD. So we have these various computations in the background to give us the context of all our regression lines and our stretches. And then we are looking at how tightly compressed those regression lines are compared to the Z3 scores. And then we use this table in here to determine if the regression lines are inside of the pinches. I'm using the envelope of 3 standard deviations right now, and then it gets a 1 if, for instance, the RL90 is inside the Z3 pinch. He gets a 1. In this case, the RL270s, all these zeros, these are ones where the RL270 was not inside the pinch area, so that gets a 0. This column totals up all the numbers of regression lines that are inside the pinch, and the ones that are a 4 then get highlighted on our other report to show us which symbols are in the super pinch, so that we can come out here and find the ones that where they are both pinched and the regression lines are in the super pinch, and that lets us do all the math behind the scenes and populate our report so we can act just on the things that give us some mathematical advantage. So maybe more information than you needed, but for those of us out there who appreciate the power of math and spreadsheets, this a little fun with numbers that I thought I would share with you. So thanks for your kind attention. That's 2 case studies on how we use multiple time frames and trade framing, starting with candidates that meet our criteria for pinchiness and tightly compressed RLs, and then allow us to set up a combination of both intraday trades and swing trades on symbols that give us the kind of potential that we're looking for. It begins with a pinch and then allows us to expand from there. So thanks for your kind attention.